Hey, this is Rajat Bose here. We have come again to present our 7th edition of Weekend Stock Recommendations and Market Outlook. As usual, today we are going to cover three indices: the Nifty, the Bank Nifty and the cnxmidcap. This week, the Nifty saw a seesaw movement, especially on the last two sessions. There had been quite a bit of selling. On Thursday, there had been this RBI monetary policy. Because of that, RBI was a bit hawkish because it was actually looking for that 4% inflation target to be achieved. Dr. Das emphasized on that. Also, the Australian government's warning about El Nino, that created a lot of problems. We begin our discussion with the Nifty. The Nifty on the 75-minute chart, especially on the last couple of days, we have seen that the Nifty has actually come down after testing a high of 18,777. There had been two highs on the 75-minute chart. One is 18,777 and the other one is 18,770. And from there we have seen that the last 10 candles, one is a doji and all others are actually red candles. That is, the open is higher and the close is lower. Finally, we see that this 75 on the 75-minute chart, the 50-unit moving average, which is now located at 18,571. It has closed very close to that, 18,567 on this chart. So there is weakness, but at the same time, one must say, looking at the 75-minute chart, that whenever there has been red or 10 or 11 red candles, it actually opens the possibility of another pullback. This time, if that pullback were to happen early part of next week, what we need to see is that the range between 18,700 to about 18,900 would be very important, and psychological resistance of 19,000 would be there. But if the mid-cap stocks as well as the banking stocks and other sectoral stocks, they need to perform in order for the Nifty to actually post a higher high. Even if it were to post a higher high, the breakdown in the 14 RSI on the 75-minute chart is a matter of some concern, because it is already below 50. It closed around, say, 42.05 on the 75-minute chart. That means the momentum is diminishing. That's the cause for concern. Now we are going to the 125-minute chart to have somewhat better clarity for the shorter term. Here also we see that the last 5 125-minute sessions had been that of weakness, and on this chart it has broken both the 9 and 20 unit moving averages and headed towards the 50 unit moving averages, and the 20 unit moving average was supporting it right from the month of June, but now onset of the month of June, but now it has been breached, and we need to see whether again it tests the 50 unit moving average, which is currently located at, say, 18,495. So this 125-minute chart also suggests some amount of weakness in the Nifty, but if it were to bounce back, we need to see that 18,700 through 18,900 needs to be taken out. Now we are going to the daily chart. In the daily chart, what we find is that the 9-day exponential moving average has just been tested. The 20-day has not been tested. So if we see a bounce back and we see it getting past 18,700 to 18,900 range, then we would have a new high as well as fresh strength to come in. By the way, at the moment what we see is that there are two resistance levels or target levels that we can see. 18,680 might act as a resistance because that's a Fibonacci level, and 18,947, even if it were to post a new high above 18,887 prior to taking out 19,000 mark, this Fibonacci resistance level, this is 1.618 times Fibonacci. So this is quite an important thing, and it is also close to that 18,950 mark. So 18,947.80 is actually a very important resistance level if the Nifty manages to reverse its downswing, and for the last couple of sessions that we have seen, if it were to post a new high, then this will be the next resistance. On the downside, unless 18,000 level, unless 18,440 where the 20 unit moving average is located, and 18,169 which is the 50 unit moving average, unless these levels are down, then these levels are penetrated on the downside, we would have to say that the Nifty hasn't yet reversed its intermediate uptrend. However, there can be a short-term downswing, which would be a correction in the intermediate uptrend. Let's see how things pan out. If we fall below 18,169, that's the 50-day moving average of the Nifty, then this intermediate uptrend will be terminated. Else, it will just be a correction. But for now, we need to first watch out the 20 unit moving average of 18,443. If that doesn't get taken out, then there is no problem at all. This week the Bank Nifty actually seesawed quite a bit. It was the weaker index. In fact, among the three indices that we discussed, Bank Nifty's performance was the weakest of the lot. It was testing 20-day exponential moving average, and it was seesawing between 44,500 and 44,000. This 500 point, the whole week this index oscillated between these two ranges. What is going to happen? Would it go below 44,000? Would it go even 43,500? Or there is this probability of 44,500 being taken out? Let's see how things pan out. We discussed the charts, 75 minutes to 125 minutes, daily chart, weekly chart, 4 different types of charts for the Bank Nifty, for this is the weakest index. Bank Nifty closed at 43,990, just a shade below the 44,000 mark, and this Bank Nifty actually has been moving up in a projectile fashion. Like a projectile moves in the air, it is also moving up in that fashion, and that has the movement has begun late March, early April, and it has still been being continued over say 2 months. This kind of a movement is continuing. Now what we need to see is that the 200 unit moving average is at 200 unit exponential moving average is at 43,326. Till such time the Bank Nifty falls below 43,300, 43,200, these kind of levels, we would say that it is not still a matter of great concern. But suppose if it were to fall below 43,300 and also breaches 43,000 mark, then definitely there would be some kind of a serious correction that is ensuing. So we need to be very vigilant. Above 44,500, if the bank nifty moves, then even the 75-minute chart shows that bank nifty will gather fresh strength. But if it were to fall below 43,500, that would be 43,300, that would be a major cause for concern. And if 43,000 levels are broken, then probably a downtrend, a corrective downswing has begun. Now we move on to the daily chart. Here what we see is this, that this daily chart suggests that the moving averages, the Fibonacci levels are all still supporting. But one thing is very, very clear, that the 20-day moving average is being tested a number of times, and 9-day has already been breached. And today, on Friday, that is the last day of the foregoing week, the 20-unit moving average was at 43,987, and it has closed just above that. So chances are that bank nifty might fall. And if it fails to hold the 43,700 mark, then there would be more problems, and we can expect, in that case, 43,575, and below that there would be further downswing. Further downswing can happen when the 43,000 mark will also be tested. Bank nifty, among all the three indices, bank nifty looks the most vulnerable, although the strongest one is also showing some vulnerability, that is the cnxmidcap, which we are going to discuss after this bank nifty. But suffice it to say that the projectile kind of a movement that we have seen in the 75-minute chart is also found on the daily chart. So this kind of movements generally, after they lose their momentum, after the highs are not being rescaled or taken out, that means the momentum is fizzling out, and chances are we would see at least some kind of a small correction in the bank nifty. The bank nifty weekly chart shows that unless the 9-week exponential moving average is taken out on the downside in a decisive manner, bank nifty doesn't become bearish, but that level is at 43,251. When we were studying the daily chart, that also showed that the range between, say, 43,300 to about 43,000, that is the most critical zone, for the critical support zone for the bank nifty. If that gets taken out, definitely we are headed for lower levels. cnxmidcap, if you remember, I talked about CNX as the strongest trend index up to last week. Has that changed? Out of 5 sessions, it posted a white candle or a green candle only on Wednesday. Otherwise, CNX also faltered. Is it going to test its 9-day EMA, which has been supporting the index for all these weeks? In fact, since early April, CNX never faltered. Would it go down this time, this week? Let's see how things pan out. CNX midcap 100 for the week starting 12th of June to 16th of June. The chart that you can see is the chart that I am introducing for the first time. This is the monthly chart of CNX midcap 100. It is not just the monthly chart, it is the lifetime chart of CNX midcap 100. CNX midcap 100 started somewhere around 2003, and as you can see that we have actually drawn a Gann angle. This Gann angle setup shows that the 2008 high was captured by 1 by 3 Gann angle. 1 by 3 means where price appreciates 3 times over time. Time is 1 unit, price goes up by 3 units. That was the pace of the 2008. That 2008 1 by 3 Gann angle, recently it was first tested in September, October 2021. After that, it again came down below that in January 2022. January 2022, it came down to something like 25,000 level. From there, the current upswing began with a 4-month-old correction in between, and now it is at 34,153. And as you can see that this Gann angle has actually resisted. This Gann angle has resisted the cnxmidcap 100 index again at the highest level. It has been resisted, it was breached, and then it came down to 25,000 level. From the level of 33,000, correction completed. It is again trying to cross this special monthly Gann angle. This is the lifetime chart. On that, again it is trying to cross this. This has got special importance because this is the lifetime chart, and this Gann angle actually encapsulates almost 20 years of trading, on 20 years of time series for cnxmidcap on monthly candle basis. So this huge run that you have seen in the cnxmidcap might be strongly resisted around this 34,000 level. 34,000 level is not yet decisively breached. It was breached, this Gann angle breached about around 29,000 or so, or 30,000 in October 2021, but after that it fell again in January 2022, as I told you. Now it is again testing in the middle of 2023, but my feeling is that this huge run up from the bottom of 2020, it was around below 12,000 level. From there it has moved up to 34,000 level. Now there are every chances that the cnxmidcap index may go for a long period of consolidation. Do not expect this humongous bull run in midcap stocks to continue. Rather, now there will be a lot of distribution in some mid-cap stocks that I foresee, because when the index hits a major roadblock like a 20-year-old Gann angle, then there has to be some kind of distribution again. This will be negated only if the mid-cap index moves up another 10% from the current level. That is, if it were to cross 37,500, then you can say that there is no more chances of immediate, in a few months time, that will be retraced or something like that, because a 10% plus retracement, 10% plus breach will take care of this mid-cap index movement. While the cnxmidcap 100 on the monthly chart, the lifetime chart, it definitely raises some concern that at least the upswing that was continuing may get halted, and there could be range bound movement going forward, because probably this uptrend is too overstretched, and there has to be some consolidation. Now, coming to the shorter time frame, that is on the daily chart, here what you see is that this mid-cap 100 is still moving between the 9-day exponential moving average and upper Bollinger Band. That being the case, we cannot say that the mid-cap index trend has been terminated, at least from a shorter term perspective. The daily chart shows that the 9-day EMA at 33,957 has not been violated. The mid-cap index has not tasted that for more than 3 weeks. It may taste in the coming week, but not yet. But we need to be a bit more vigilant now and not gung-ho about the performance of the CNX mid-cap index, because the lifetime chart indications should never be ignored. So I would suggest that you need to be a bit more wary of buying mid-caps in a gung-ho mode. Now, if we look at the 125-minute chart, you will notice that after a fairly long period of time, that is in the month of May, the mid-cap index tested on the 125-minute chart the 50-unit moving average. Once again, we see that the 9-unit moving average on the 125-minute chart is actually breaching the 20-unit moving average. So even in the shorter term, even on intraday basis, weakness is developing in the mid-cap, which last week we found that from every aspect the upswings were continuing. But now we see negative divergences, we see MACD negative crossovers. So we need to be a bit more skeptical about the playing on the long side with all the enthusiasm that we earlier had. We need to see whether the mid-cap index falls below the 33,700 mark or not. If 33,700 to about 33,500 levels are breached, then mid-cap index actually might underperform. This time we have chosen one automotive counter, and the other counter is a power sector stock. Even when the other stocks are dwindling, other stocks are faltering, these are the two stocks. They have great potential going forward. Over the next few weeks, they are going to perform much better. The heavy duty stock, or rather the heavy duty vehicle stock, Ashok Leyland. Ashok Leyland is likely to perform despite the fact that there is some market weakness. Ashok Leyland, which closed around 153, is likely to move up, and it would give a good amount of appreciation over the short to medium term. We are going to discuss Ashok Leyland threadbare. Let's see how the charts are showing the stock's performance. Is actually showing, you may call it an inverse head and shoulder pattern. You may call it a cup and handle pattern, but the pattern is bullish. That's the point. So Ashok Leyland around February posted a high of 156, and from there it took quite a bit of time to come down to something like 135, where it posted a bottom, and there was an inverted bottom saucer formation, a rounding bottom formation. So this stock again tested 154 kind of levels. After that, there had been again a fall. This time the fall was arrested in the early 140s, and from there it has moved up again. Friday it closed at 152.35. From here I expect a breakout. When Ashok Leyland gives a breakout, we find that after so much of consolidation, and the 9-day exponential moving average is cutting the 20-day exponential moving average from below, so some momentum is definitely going to be generated. Although it fell on Friday in line with the market direction, but I am expecting it to go up and scale up to initially 162. That would be the first target. 170 will be the second target, and my third target will be 175. Where do we put the stop loss? We put the stop loss below 145 on closing price basis. So 7 or 8 points on the downside, and you have a 21 to 22 points on the upside. It's a 1:3 trade. Time duration would be 1 month to about 9 weeks. That means roughly 1 to 2 months time, in which I expect Ashok Leyland to complete its journey. Charts are pretty encouraging. The pattern is pretty encouraging. You can try it out, but don't forget the stop loss and also part profit booking once the targets are hit. If you like my presentation, then please press the like button, subscribe to my channel, and also share it among others. Our second stock, the power sector stock, this time a giant power sector company, NTPC. It moves slowly, but it gives slow movement on the upside. That's why NTPC, after testing a level of 180, it came down and then it has started moving up, and now NTPC is also showing a cup and handle formation. This formation is a bullish formation, and prior to developing this cup and handle, if you see when you look at the yearly chart, you will find that it was moving in a narrow band, and that narrow band, after that there was an excursion to about 160 to 170 kind of levels. From there it came down, and now it is moving up. Now NTPC has closed at around say 182. From here I expect it to scale up to 200 rupees. 200 rupee mark, this is roughly a 10% rise, and on the way to 180, on the way to 200, there would be 3 targets. First will be 189 to 181. This range will offer some resistance. After that it would be 195, and then it will be 200 to 201. So that's the kind of scenario that I am looking at, and for NTPC your stop loss should be placed below 173. 173, that's actually a 9-point kind of a stop loss, and you have on the upside something like 18 to 20 points. I have taken a longer stop of 173 for the simple reason that actually the major support is 175, but 173 on closing price basis or on intraday basis, if you take, you are on a much safer wicket, because I've seen one thing, that if NTPC shows a bullish pattern, it actually completes the pattern where it also meets its projection, but you have to be a little more patient. So a 10% run on NTPC from for a time period of 1 month to about 3 months, and you have a stop loss of 9 points. Please be mindful of stop loss. If it were to hit that, then you should exit the position, but I am expecting it to scale up to 200 before it really goes down. Thanks for watching our presentation.